One last question, I think, because you've done a great job of explaining a lot of concepts I think our audience is really going to enjoy. There's talk about, this time's different and people should be doing something different because of the COVID-19. I think, I like to end on a positive note and where the opportunities lie for investors. If you had to say what investors should be doing right now, you mentioned financial planning, making sure everything syncs up together, but what are really the opportunities of all age investors, whether someone's still working, retired? What are the opportunities that investors should be taking advantage of today?
To me, the opportunity, is always tied to what you said, to your financial plan. So even as I'll mention some opportunities, that doesn't mean that one should just sell everything and put the money there. I think a lot of it, the opportunity means that you stick with the plan, but you don't disengage from something that might not be flying high at the moment. So I think a lot of times the opportunity is by looking at what has gotten beaten down, because the beaten down means that the price at which you buy them is lower. And the way you capture that opportunity is through a process that's predetermined, that is called rebalancing. And what it basically means is that if you have some sort of a alignment, you have allocation between, let's say, stocks and bonds, if stocks drop, then what you want to do is look at it as an opportunity to buy a little bit of valuation. But the fundamental premise is not just, let's just go buy stock wildly. Let's go buy stocks so we can realign the portfolio to where it ought to be. And right now, where I see the opportunity, let me for a minute maybe go back and see where I personally don't see as much opportunity in the way that other people do. And a lot of folks right now are just very enamored with what I call the pharma stocks, Facebook, Amazon, Apple, Microsoft, and Alphabet, the parent of Google. And everybody's just so enamored and saying, well, that's where the world is going. It's like they're dominant, they're going to take over the world. And I'm more like, hold off a second, because when you actually do research, the question is, when a company becomes as dominant, what happens? And we have run this research, and what we find is, going back to the 1930s, is that companies that become dominant in the market, they do tend to stay dominant. So you take a company like AT&T, from the 1930s all the way into the 1990s, it was in the top 5. You'd have IBM, that's been from the 60s to the 2010s. And you have General Electric from the 1930s all the way to 2010 being a top 10 company. So there's no, I'm not here to tell you that once companies like these pharma stocks get in the top 10, they might stay there. I think that the opportunity for an investor is to ask a different question. Once a company becomes large and dominant, is it also a great investment? And they're not the same thing. And in fact, if you run the research and you look and see what happens to these companies once they get in the top 10, what you see is that over the short run, over about 3 years out, they do tend to outperform the market by about 0.7% per year over the next 3 years after they join. But eventually, and it's also intuitive, they start running out of steam, because it's harder to grow and, let's say, double in size if you're somebody like Amazon or Facebook. And over the 5 years, they actually are trailing the market by 1%. And if you look at 10 years, they are significantly trailing the market by 1.7%. So the companies that everybody's so enamored right now, these large technology stocks, to me, I'd say be careful, because first of all, they are very expensive to own. You pay a lot to own them. And secondly, they might not have much room to grow as you might think. So the way that I look at opportunity right now is to, again, parse out the stock market into different categories. And to me, you have these large companies like the ones that I mentioned now, and that's the S&P 500. And about a fifth of the S&P 500 is in these 5 companies. And separately from that, there are about 2,000 other companies that are smaller, and they're not part of the S&P. So if you look at the growth potential over the long run, we kind of saw that from a few minutes ago, that $1 invested over the long run in the S&P had grown to about $7,000 through the end of 2018. Over the same period, the same dollar invested in these smaller companies, which are not part of the S&P, would have grown to roughly about 27,000 based on the numbers from the 2019 Matrix book. And then within large and within small, there's also a delineation based on the price that you pay to own these companies. And the low price companies are called value stocks. And this is relative to a company fundamental, like book value, for example. And the low price companies, they too tend to outperform over the long run the more expensive counterparts called growth. So knowing that small beats large and value beats growth, the one part of the market that ought to give investors the biggest bang for the buck over the long run is small and value. And the same dollar growth over the same time period is about $72,000 in small value. So once again, significantly more. It's not there every day, every quarter, roughly about 60% of the time in any given year you see it. So that's kind of why nobody wants to put all the money in small value. But I'll tell you the opportunity, because I wanted to get the opportunity is to pay attention to the entire stock market and look at the price that you pay. It's all about the price. If you look right now at these large, expensive companies, large growth, and you say, well, how much does it cost me to buy $1 billion in assets after the company pays its liabilities? So that's the book values, assets left over after paying the liabilities. The price to book ratio kind of tells you how much it would cost you to buy that $1 billion. And right now for large growth, last time I checked, not too long ago, it was about $10 billion. So you spend $10 billion to buy $1 billion in assets in book value from these large growth companies. If you look at small value and you ask, okay, well, how much would it cost me in small value to buy the same $1 billion in assets? Last time I checked, it was roughly about 900 million. And that to me is what investors ought to be looking at, is like, how much am I paying? And you can either pay 10 billion to own $1 billion, or you can pay 900 million, almost like pennies on the dollar. And it doesn't mean that you should go buy all small value, not at all. I think that you ought to keep that in mind and make it part of the portfolio in a balanced way, but not just be attracted to the shiny object that you have these large, expensive companies that everybody says they're the future. Well, they might be dominant, but in terms of what you see happening to them afterwards and how expensive they become, I think it's worthwhile balancing all that with diversification throughout the market.
No, I love that perspective, Apollo. I think that's fantastic, and a good point to end on, because we believe in diversification here, and while things we can't predict or try to forecast, we like to stack the odds in our clients' favor. And I think this discussion you just mentioned in the last couple of minutes is a really good point to end on. So again, my good friend Apollo Lupescu with Dimensional Fund Advisors, thank you so much for your time today. We'll have to have you back in a few months and really dive in to see what's actually happening with some of those prices. So thanks again, everybody, for joining today, and talk to you soon.
Bye.